Welcome, ladies and gentlemen. Thank you to Kevin Carter, who's joined us from EMQQ. Now, just to confuse you all, EMQQ is the US dollar ticker. We're using EMQP, which is the GBP London ticker. But it's an emerging market internet story. I had the pleasure of meeting Kevin a few years ago to hear this. It's a fascinating way to look at the world. If you just take a standard internet, sorry, I beg your pardon, an emerging market index, it might be full of state-owned enterprises, large banks in China for many years, for example, or big old industrial black and white television producers back in the day. But the world's moved on, it's modernized, and Kevin very cleverly put all the internet stocks together from around the world and came up with the concept of EMQQ. Welcome, Kevin.
Thank you. Well, glad to be here.
So could you just please go back and just tell me how you got to EMQQ, where you came from, what inspired the thinking, and how the index is constructed?
Sure. Well, I mean, the long story short is I live in San Francisco, so I've kind of grown up in and around the technology progress over the last 50 years, and I started 30 years ago in downtown San Francisco at what was the leading investment bank at the time for technology companies. So I've been in and around technology for a long time. I got involved with emerging markets about 20 years ago. I have a longtime business partner who's a Princeton economist named Burt Malkiel, who some of your friends might know. He wrote a book called The Random Walk Down Wall Street, which basically laid forward the idea of an index fund. And then later he was in charge of the first ETF launch, the Spider. So I've worked with that guy for a long time, and he got interested in China. A couple of his Princeton economist friends were Chinese economists, and they had gone back to teach in Beijing around the year 2000 and convinced him that he had to come see what was going on, this incredible growth that was happening. And so he started going to China and wrote a white paper about China. And then a bunch of our investors looked at me and said, well, we want to invest in China. And so that was 18 years ago last week. And so I've been focused on trying to figure out what that even means for almost 20 years now. And emerging markets have long held a lot of promise. I mean, implicit in the word emerging is some kind of growth, and the base story is that this is where all the people are. There's 85% of the world's people are in emerging markets, and they're younger. Their economies are growing twice as fast as the developed world, and that's driving what McKinsey calls the biggest growth story in the history of capitalism, which is the rise of the emerging market consumer. So, really from the beginning, what I've been focused on is, maximizing the exposure to that consumer growth story. And as you touched on, trying to get rid of all the problems, the government-owned banks and oil companies that are corrupt and inefficient, and companies like Petrobras, the Brazilian state-owned oil giant that was literally systematically looted for a decade by the last two presidents and a third of the Congress people. So it's been all about the consumer. And I had launched a number of China ETFs with Guggenheim starting around the year 2007. But when people would call me and ask me, what's the best emerging markets ETF, I always told them to just buy the emerging market consumer ETF, right? The food and clothing companies that would benefit from these 6.5 billion new consumers. And it could have been 10 years ago today. I got a phone call from a friend, and I was in my car, and I answered her call on my iPhone, my first iPhone. And she asked what was the best emerging markets ETF for a child's college fund, and I started to tell her to buy the consumer stocks. And then I had my light bulb moment, if you will, for EMQQ, because what I realized was this device was changing how we consumed. And even 10 years ago, I could see that there was a delivery truck in my front driveway, once a week and then twice a week, and then I knew the driver by name. And so basically, that's how EMQQ came to be. And I didn't see it as clearly then as I do now. But basically, there's three mega trends that are sweeping the planet. I'm part of all of them. You're probably been part of all of them, like I have for a couple or even more generations. But most of the world's just getting involved. So those three mega trends are, first, the rise of all these other consumers. Second, the computer, because when I got that call 10 years ago, I had a computer for 20 years before I had a smartphone. But 10 years ago, my smartphone was basically brand new. But most of the world is getting their first computer today. It's not a desktop and it's not an Apple product. It's an Android-based smartphone. And when they get that first pocket-sized supercomputer, they're also getting the internet for the first time. And because they've never had a bank account or a credit card or any kind of digital payment, they've never had a Target store, they don't have an automobile, they're leapfrogging and driving what I think is the fastest growing sector in the world, which is the emerging markets internet sector.
Fabulous. And you mentioned, I think in one of the pieces I wrote, I read that you had written, was talking about a $14 smartphone in India.
Well, that's true, a $12 smartphone. Okay. So this is, one of the things that makes India exciting, as it looks a lot like China did when I got started, but when I got involved, nobody on the planet had a smartphone. And not only, can you get a smartphone, but now, as you mentioned, you can get one for, $12 or $14, brand new. It may not be an Apple, iPhone 15, but if you want to make payments or watch video, it does the job.
Yeah. And we'll get back on track, but I just want to mention I was in Uzbekistan 2 weeks ago, and every taxi I took was on Yandex Go. You couldn't get a taxi without it. And that was sort of pretty eye-opening stuff. So look, let's talk about the EMQQ, and don't forget, everyone, it's EMQP for us. Let's talk about the index construction. How do you put it together? Is it rules-based, or is there an investment committee? Are you thinking about the companies? What is it?
Well, I mean, it's rules-based, but we certainly put a lot of thought into how the index is put together, certainly more than the average, index operation. And the reason is, every stock, every company in the world gets put into a database. And so you end up putting these companies in boxes. Like, what country are you in? And you can only be in one country. And so sometimes a company will have its headquarters in Singapore, for example. All of the major e-commerce companies in Southeast Asia are based in Singapore. So the database sees Singapore, and that's a developed country. But the revenue for those companies is coming from Indonesia and the Philippines and Vietnam. So that's the first rule, is you need to be an emerging markets internet company. We don't care what country your mailbox is in, and we don't care what stock exchange you're on. And unfortunately, a lot of indexes, they just look at those things, and you'll take, a Chinese company trading on the NASDAQ won't be included in the China index, and things like that. So the first rule is you need to be an emerging markets internet company. Right now, there's about 120 of those. You've got to obviously be publicly traded. And then if you are that, no matter what stock exchange you're on or what country you're in, and you meet our liquidity and market cap minimums, we'll include you. And then it's a modified market cap weighted, which basically we cap the largest stock at 8% when we do the rebalance, which is twice a year in June and December.
Okay, and it's it's been an interesting story and all the rest of it. Now I want to talk about two things: the US relative valuation, but the other thing before we get there, obviously with the war in Ukraine, there was a stumble. I've mentioned Yandex. What happened there? What countries are excluded? How do you approach listings? For example, if a company's got an American quote and a Hong Kong quote, for example, what would you choose, and how do you get there?
Sure. Well, in terms of listing venue, we're agnostic in terms of where you're listed. We try to buy the stocks wherever they're cheapest. To a lot of exchanges in emerging markets have a lot higher costs. So buying and selling in India is a lot more expensive than buying and selling in the United States. So we take that into account, but other than that, we'll own you. Now, in the case of Russia and Yandex, some of your investors may know that when the Russians invaded Ukraine, it became illegal to buy or sell a Russian stock, and all the stocks were suspended. And we had, I think, 6 Russian internet companies, a few of which had only been public for a couple of years, and were, these were probably some of the most entrepreneurial and not state-involved businesses in Russia. But nonetheless, the stocks were halted, and essentially all of them were priced at zero. So we took a big hit that day. I think Russia was about 3% of our portfolio, and all of those stocks went to zero. Now, interestingly, we still own the stocks, and they show up on the balance sheet, but with a value of zero. And in the case of Yandex in particular, I believe that the company's headquartered in the Netherlands. And as you mentioned, they have in addition to being the Google of Russia, they're also the Uber of Russia and other, nearby countries, as you mentioned, Uzbekistan. And but my understanding is they have a cash offer to sell the business or part of the business to a group of Russian buyers for, I believe, $5 billion. So it's possible that, in fact, we'll recoup some of the losses we took from that situation. But that's emerging markets have a lot of risks, and certainly wars and governance of not only companies but countries certainly a risk in not just emerging markets, but.
Okay, so which kind of brings me to the next question. We've seen US tech do extremely well. European tech, well, there isn't much of it because the US bought it all or set it all up, and emerging tech. Why is it traded at such a discount to the US, and specifically, what's gone wrong with China in the last 2 years?
Sure. Well, I think that the simplest answer to your first question is that the valuations are low because of China. And because investors in the U.S. and I think to a lesser extent in Europe, but certainly the U.S., they're afraid of China, and they're afraid to invest in China. They've seen all these headlines about things that sounded really scary. The two main ones that both have gone away, but people don't understand that they've gone away. But the two big fears that people had were, first, that the Chinese internet companies trading in the United States were going to be delisted. And that was a threat that the U.S. Senate had passed a bill to delist these companies because of an accounting agreement that was not in place, whereby the accounting watchdog of the United States could go and look at the audit notes of any company listed in the U.S. and this was definitely a politically election year driven thing, because that rule has been in place for 20 years and we never enforced it until there was an election. And I had a lot of questions about, well, why didn't we enforce this in the first place? We have these rules. Why have we not enforced them for 20 years? And so anyhow, that scared people, and you heard it over and over again, delisting, and they had a watch list of companies, and every time they updated the watch list, even though it was a 3-year threat, it was, if you don't do this in 3 years, we might delist your companies. People thought they were going to lose all their money, and it was just silliness. And it was resolved. Finally, the accounting watchdog in the U.S. was part of the problem. The SEC had fired all of the leadership, so it took 9 months to replace the accounting watchdog representatives of our country to engage with China. Once that happened, they cleared that up almost 2 years ago, but people don't understand that because they saw the headlines so many times. So you had that fear, and then you had this China tech crackdown fear, where the Ant Group, Alibaba's fintech IPO, was canceled, and you had these antitrust and monopoly reviews, and every one of those situations, there was 4 different regulatory things. I as an expert in China, I thought this isn't a big deal. I agree with what they did. I thought the Ant Group needed to be regulated more like a bank. I thought, and everybody should know, that Alibaba and Tencent were very monopolistic because they had a lot of power. And so all the things that the Chinese government did that were, construed as a crackdown, they're no different than what happens in Europe and in the United States. I mean, the people at Google must pay, billions of dollars in fines every year in Europe, and you see our tech titans in Washington, D.C. So So anyhow, but because people are afraid of China, when they regulate, everyone thinks, oh my gosh, they're trying to steal my money. So I think those were the two main things that drove the China stocks down. I think, again, both of those have been resolved. I mean, the second, the crackdown wasn't really an issue except in people's minds. I mean, they're definitely, regulating their sectors as we do, but they've made it clear that they support private enterprise and they're not against the internet companies and that they believe in capitalism. I mean, they should. That's how they got here. And so it's just been a firestorm of negativity. And then you have the US tech, trade war. So it's created incredibly low valuations for the Chinese internet companies. I mean, they could double and they wouldn't be expensive.
Absolutely. And I'm going to cover more of that. You put an excellent slide, which I'm going to take and put in the piece that will accompany this video. You're really bullish on India. You've done some excellent work there, some fascinating statistics. 2/3 of the people are going to be middle income by 2030, this sort of thing. Biggest country in the world by population, and the sort of tech miracle that we've seen in China with high-speed rail and so forth is coming to India. It's going to be changed and transformed, isn't it? So perhaps you want to tell us a little bit about that?
Sure. Well, India is here. It's finally here. And, like a lot of people, we've been waiting for India. I mean, when we launched 10 years ago in the US, we had 0.5% invested in India and, more than 50% in China. And it wasn't because we didn't, want to invest in India. There was only 2 public companies and they weren't that large. And, even 3.5 years ago, we were still 1% in India, but finally, and incredibly, right during the COVID, from 2020 to 2021, they did 25 IPOs. 20, not all the leading ones, but many of the 25 of the leading Indian internet companies went public in a 1.5 year period. And so finally, we got a meaningful exposure. So it's become a bigger and bigger part of what we do here. And here's what I say about India. First of all, it is the perfect emerging market, and it can't really happen again. And the reason I say that is, if we go back to why invest in emerging markets in the first place, there's 4 reasons. First of all, they're very, very big. They have all the world's people. Okay, India is, as you mentioned, now it's the largest population in the world. It passed China a year ago. Today, India set a record as the largest population ever. Tomorrow, it will set a record. And basically every day for the rest of my life, on that day, India will be the biggest country ever. And if you leave out China, India is bigger than every other emerging market combined. I mean, the second biggest population is 285 million in Indonesia. And, it won't get to 500 million. India's at 1.5 billion. So it can't really happen again in terms of the scale. And it's young. It's the second reason you want to invest in emerging markets is they have a younger population. And India has twice as many people under the age of 30 as the entire US population. So it's the biggest, it's the youngest, it's fastest growing. Its estimates are 6.5%, which is twice the developed world's GDP growth. But they've just beat that number 3 quarters in a row with a 7%, and then an 8.4%. Again, with a 6.5% estimate. So I think the estimates are going to go up. It might be accelerating. And then finally, that's driving consumption. And that's the reason we're here in the first place in emerging markets is all these new consumers. And when you add the size, the demographics, the growth rate, India is expected to have more consumption than China does in the next 10 or 12 years. And 20 years out, significantly more. So if those are the things you're looking for, I mean, you're not going to find anything better than this. And it's not even close. So then you add in, the fact that the country has probably the most stable democracy on the planet right now. And, with, again, things like Russia and Putin, I mean, governance can be a real risk in emerging markets. And of course, Americans think communism is evil. And so we, give China a low marks in that category. Well, here you've got the world's largest democracy, and you have this leader who has grabbed the country and dragged it up. And, Modi's finishing his 10th year, and he's got the highest approval rating in the world, and he's going to get reelected here. The voting just started. It'll end in the first week of June, and he'll get reelected to a third 5-year term. And he has basically brought the country from socialism and bureaucracy, and he's running it like a company, and he's running the whole country like a business, and he's cutting out all sorts of the red tape and bureaucracy that made it hard for capitalism to flourish. But he's also, perhaps most importantly, he's doubled the country's infrastructure in his first 10 years. And whether it's the miles of highways or the number of airports, everything has been doubled. And he's not done. They got $1.5 trillion plan that'll electrify the rest of the rail network. They're building new stations, remodeling stations. They've doubled the miles of highways. They're tripling the number of airports, and they're building the seaports they'll need to get, products in and out of the country on a boat. And so that will feed, the ability to move manufacturing to China. So you have this government that's finally running the country like a business. And you could really, just as Deng Xiaoping unleashed capitalism in China, Modi's basically acting in that role here in India. And so, but then you layer on top of that two other things. The first is that, India has a technology sector that's older than me. You've got these publicly traded technology companies, Infosys, Tata, TCS, Tata, that, they've publicly traded for 20, 30 years, and they've employed, hundreds and hundreds of thousands of technologists. They have an incredible set of technology institutes modeled after MIT. You've got 25 S&P 500 companies have Indian CEOs, including Google and Microsoft, and both of those CEOs were educated at India's best school. So you're not going to find that in Indonesia or Vietnam or any of those places. And then on top of all of this, partially because of the last point, India has a secret weapon that people just don't understand, and I didn't understand it until 2 years ago. And it is it's unlike anything on the planet, and it's a digital public infrastructure. It's like an operating system for the whole country that cuts out costs and it cuts out corruption, and no other country, developed or emerging, has it. And it's called the India Stack, is what they call this. But that, to me, is the cherry on the top of this India story. And part of the reason I'm excited about India is because nobody knows about this. I mean, I talked to hundreds of investors, and none, 0.1% have any idea about this technology system that India has built for itself that's really showing incredible power.
And I think there was a story, and I'm going to get the numbers wrong, but there was something like 1 million people or 2 million people who were still being paid by the Indian railways who were dead. Isn't that right? And this was one of the things that they brought in this new system, and it uncovered all this fraud and inefficiency in the system.
Well, I'm not familiar with that, but that sounds absolutely like something that would happen the whole country was operating on paper-based files. I mean, the entire government was. And parts of it still are, but they've made up a lot of ground on the technology side, and they're all in a way that people don't understand. Which, part of it is, people don't know what digital public infrastructure is. When I ask them, people like, what is digital public infrastructure? Do you use any? And no one seems to even know what that means. And that's the internet is the best example of digital public infrastructure, right? It's digital. It's public, everyone can use it, and we don't really see it, though, right? GPS is another example. So we're using digital public infrastructure in our own lives, and we can see, business models like Uber that, really couldn't exist without these things. So not only does India have access to those things, but they've also made their own pieces that if you stack them all together, it's created this incredibly dynamic and never before seen platform of digitization for all elements of the Indian economy.
Brilliant. Well, Kevin, I'm going to leave it there and just say thank you very much. It's been really interesting. I only wanted to do a short video to bring your ETF that we recommended last week to life for our clients. And I think it's a wonderful idea. It really makes so much sense that you take a geography and you put the digital on top of it, and then see how that can transform what's underneath the surface. So good luck with everything, and I hope that China internet and India internet come back into favor as they deserve to be.
Thanks, Charlie.